One mine in Botswana generates over $2.7 billion in diamond revenue annually and funds roughly one-third of an entire nation's government budget. That's $7.4 million every single day, while you sleep, while you work, while you're reading this sentence, pouring out of a single pit in the Kalahari Desert that transformed one of Africa's poorest countries into an upper-middle income success story. Welcome to the story of Jwaneng, the world's richest diamond mine by value and the financial engine behind Botswana's economic miracle. This isn't just another mining operation. It's a geological wonder that produces 13.3 million carats per year, processes 107 million tons of rock annually, and contributes more to its host country's GDP than entire industries do in most nations. The numbers behind Jwaneng defy belief. At average market prices of $200 per carat for high-quality gem diamonds, this mine generates approximately $2.7 billion in annual revenue from diamond sales alone. That's enough to fund every public school, every hospital, every road project, and a significant portion of government operations in a country of 2.6 million people. But here's what makes this story truly extraordinary. In 1966, when Botswana gained independence from Britain, the country had a GDP per capita of just $70, making it one of the poorest nations on earth. Today, that figure exceeds $7,000, and Botswana ranks as the least corrupt country in mainland Africa. This mine, played a pivotal role in that transformation. Jwaneng sits 120 kilometers west of Gaborone, Botswana's capital, in the south-central part of the country, on the edge of the Kalahari Desert. The name Jwaneng means place of small stones in Setswana, a spectacular understatement for what would become the planet's most valuable diamond deposit by value production. The mine is owned by Debswana Diamond Company, a 50-50 joint venture between the government of Botswana and De Beers Group. That represents one of the most successful mining partnerships ever negotiated. This equal ownership structure, fought for and won by Botswana's government through shrewd negotiations, ensures that diamond wealth flows directly to the nation's citizens rather than disappearing into foreign corporate coffers. Production numbers tell the scale story. In 2023, Jwaneng produced 13.3 million carats of diamonds. In 2020, despite COVID-19 impacts, the mine still delivered 7.5 million carats. Normal annual production typically ranges between 12–15 million carats, with the mine processing ore at a grade of 1.26 carats per ton. These aren't just any diamonds. Jwaneng produces high-quality gemstones that command premium prices, many of them large, flawless octahedral and dodecahedral crystals suitable for jewelry. A spectacular example, in June 2021, workers recovered a 1,098-carat gem-quality rough diamond measuring 73 millimeters long, 52 millimeters wide, and 27 millimeters thick. Now, here's where the economics get fascinating. Jwaneng alone accounts for 60–70% of Debswana's total revenue across all its mining operations. Since Debswana generates approximately one-third of Botswana's government income through taxes, royalties, and dividends, this single mine effectively contributes an estimated 20–25% of the entire national government's revenue. To put that in perspective, imagine one factory, one facility, one operation funding a quarter of the United States federal budget. That's $1.5 trillion from a single site. The strategic importance of Jwaneng to Botswana cannot be overstated. It's not just economically significant, it's existentially critical. Diamonds from Jwaneng and Debswana's other operations account for approximately 80% of Botswana's export earnings. In 2023, mining and quarrying contributed 16.7% directly to GDP, with diamond traders adding another 1.4%. Combined with multiplier effects through the economy, diamonds represent roughly 30% of Botswana's total gross domestic product. The mine currently operates as a massive open-pit operation consisting of 3 separate kimberlite pipes, volcanic structures that brought diamonds from deep in the Earth's mantle to near-surface depths millions of years ago during the Permian period. These pipes sit beneath what was originally 20-50 meters of Kalahari sand and calcrete overburden. Processing capacity reaches 11.2 million tons of ore per year through the main treatment plant and Jwaneng modular plant combined. But the mine moves far more material than that. In 2021 alone, Jwaneng extracted 107 million tons of rock. That's 293,000 tons every single day, or 12,200 tons every hour around the clock. To visualize that scale, every hour the mine removes enough rock to fill 10 Olympic-sized swimming pools. The waste-to-ore ratio at open-pit mines like Jwaneng typically ranges from 3 to 1 to 10, 1 depending on depth and ore body geometry. This means for every ton of diamond-bearing ore processed, 3 to 10 tons of barren rock must be drilled, blasted, loaded, and hauled away. It's this massive material movement that makes open-pit mining such a capital and energy-intensive operation, and why underground mining eventually becomes necessary as pits deepen. Think about that scale. The mine operates 24 hours a day, 365 days per year, never stopping. A fully loaded 250-ton dump truck departs the pit every few minutes carrying ore or waste rock. The operation employs Komatsu 930 haul trucks, massive machines that dwarf conventional vehicles, along with P&H 2500XP blast hole drills for breaking rock before excavation. The facility uses dense media separation technology to extract diamonds from crushed ore, with the world's first fully automated recovery plant called the Aquarium Project, commissioned in 2000. This system comprises a completely automated recovery plant, CARP, and a fully integrated sorthouse fish that ended hand sorting of diamonds and maximized recovery efficiency through high-tech X-ray scanning. But none of this wealth would exist without one of the most remarkable discovery stories in mining history, a tale that involves termites, persistence, and a December 1972 drill hole that changed a nation's destiny forever. Diamond exploration in what was then Botswana land began in 1955, when De Beers initiated systematic prospecting across southern Africa. The first significant success came in April 1967 with the discovery of the Orapa kimberlite pipe, a 117-hectare deposit that would become Botswana's first major diamond mine, officially commissioned in 1971. But the Jwaneng area presented unique challenges. Unlike South Africa's exposed kimberlite pipes at Kimberley, Botswana's deposits lay buried beneath thick layers of Kalahari sand, 20 to 50 meters of loose sediment that concealed geological structures from conventional surface exploration methods. The sheer thickness of the sand cover meant conventional magnetic surveys detected deep anomalies but couldn't distinguish kimberlite pipes from other igneous rocks. A 1962 reconnaissance program south of Jwaneng had failed to make any discoveries using the exploration methods available at that time. The techniques simply weren't sophisticated enough to see through the Kalahari's thick geological blanket. Geologists needed a different approach, something that could reveal what lay hidden beneath all that sand. Here's where the story gets truly unusual. Termites in the Kalahari region build their mounds by excavating material from depths of up to 70 meters below ground, bringing subsurface soil and minerals to the surface through a process called bioturbation. These insects, working for free 24/7, were effectively conducting geological sampling that would cost millions if done by drilling. Think about that. Colonies of insects working continuously for thousands of years, bringing geological samples from depths that early drilling equipment could barely reach, all accessible just by analyzing the soil composition around termite mounds. De Beers geologists realized that sampling these mounds could reveal indicator minerals, even when kimberlite pipes lay buried far below. The technique wasn't foolproof. Not every termite mound contained useful data, and distinguishing signal from noise required sophisticated analysis, but it worked well enough to guide exploration toward promising areas. De Beers geologists realized they could analyze soil from termite mounds to detect indicator minerals, specifically pyrope garnet and picroelmenite, that signal the presence of kimberlite pipes below. In 1969, improved sampling methods were applied to Kalahari-covered areas south of the future Jwaneng site, with positive results received by year-end. The critical breakthrough came in December 1972, when percussion drilling at a location called Wadali's Wish in the Naledi River Valley, known locally as the Valley of Stars, intersected kimberlite. The drill hole was designated 20424DK2, and diamond-bearing core was confirmed in early 1973. There's historical debate about whether the discovery date is 1972 or 1973. De Beers and Debswana officially recorded as 1972, though the proper confirmation with drill core came in early 1973. Another pipe, designated 2424D-K1, had been found in 1972, but exploration paused while geologists grappled with the challenge of the massive sand overburden. Between 1974 and 1977, systematic follow-up discovered additional kimberlite pipes in the complex, 2322 through 242, large-diameter drilling programs, the first to create three-dimensional diamond resource models, demonstrated economic viability despite multiple technical problems and the unprecedented depth of sand cover requiring entirely new evaluation techniques. The deposit's quality exceeded all expectations. Harry Oppenheimer, chairman of De Beers, would later call Jwaneng the most important primary deposit found anywhere in the world since the discovery at Kimberley more than a century ago. This wasn't marketing hyperbole, it was geological fact. In May 1978, De Beers Consolidated Mines Limited and the government of Botswana signed an agreement to develop Jwaneng Mine through their 50-50 joint venture Debswana. This partnership structure was crucial. Botswana negotiated aggressively to ensure equal ownership, rather than accepting minority royalty arrangements that had impoverished other resource-rich African nations. The government's negotiating position drew from hard lessons learned across the continent. Angola's diamond wealth fueled decades of civil war, while ordinary Angolans remained impoverished. The Democratic Republic of Congo saw its vast mineral resources extracted by Belgian, American, and other foreign interests with minimal local benefit, contributing to political instability and conflict. Sierra Leone's diamonds funded brutal civil war in the 1990s, with the term blood diamonds entering global vocabulary. Botswana's leadership, particularly founding President Sir Seretse Khama, studied these failures carefully and was determined to avoid repeating them. Khama himself came from royalty. He was hereditary chief of the Bangwato people, one of Botswana's main ethnic groups. But he had studied law and economics in Britain, married a white British woman, causing controversy, and developed pragmatic views about how to leverage Botswana's limited resources for development. When Orapa Mine was discovered in 1967, shortly after independence, Khama recognized this was a once-in-a-generation opportunity that required getting the commercial terms right. Initial negotiations over Orapa in the late 1960s established a precedent that Botswana would not simply accept royalty payments. The government insisted on equity ownership and profit sharing through the Debswana joint venture structure. This was revolutionary for the time. Most African nations accepted whatever terms foreign mining companies offered, desperate for any investment and lacking expertise to negotiate effectively. Botswana hired external advisors, including mining economists and legal experts, to evaluate geological reports, challenge De Beers' financial projections, and negotiate terms. The government's team understood that De Beers would walk away if terms were too onerous. There were other diamond deposits to develop, but also that Botswana's high-grade deposits gave the country leverage. The deposits were profitable enough that even reduced profit shares represented attractive returns for De Beers. The 50-50 ownership structure of Debswana meant equal representation on management boards, joint approval of major decisions, and equal sharing of dividends. But crucially, Botswana negotiated favorable tax, royalty, and export arrangements that effectively gave government claims on 75–85% of total profits from mining operations, depending on the specific mine and time period. These terms improved through multiple renegotiations in 1975, 1982, 2011, and most recently 2023. Each renegotiation occurred when previous agreements expired, giving Botswana leverage to demand better terms as mines proved profitable. And the government developed more sophisticated understanding of diamond markets. De Beers had incentive to maintain good relationships since Botswana provided roughly 20–30% of global diamond supply by value. Losing access would destabilize De Beers' market control efforts. The trust built through this partnership became self-reinforcing. Botswana proved to be a reliable, stable partner that didn't nationalize assets, respected contracts, and understood that sustainable production served both parties better than maximizing short-term extraction. De Beers provided technical expertise, marketing, and capital that Botswana couldn't generate alone. The relationship worked because both sides benefited and could credibly commit to long-term cooperation. Construction of the mine and the township commenced rapidly in 1978. Before the tarred road connecting Jwaneng to nearby Kanye was built by Debswana, the area was accessible only by four-wheel drive vehicles with high clearance. Workers and equipment had to traverse rough desert tracks to reach the remote site. The mine reached full production in July 1982, processing approximately 3 million tons of ore per annum initially, and producing about 5 million carats in its first full year. On August 1982, President Sir Ketumile Mazare officially opened Jwaneng Mine in a ceremony marking Botswana's determination to leverage its mineral wealth for national development. From 1982 onward, Jwaneng rapidly established itself as a crown jewel in global diamond production. The mine's output quality, large, high-clarity stones perfect for jewelry, commanded prices far exceeding industry averages. Where typical diamond mines might produce stones worth $50 to $100 per carat, Jwaneng's gems averaged $200 or more. By 2015, the mine was producing 7.87 million tons of ore annually, recovering 10.4 million carats and a grade of 132 carats per 100 tons. The value was not publicly reported for that year, but Jwaneng was already contributing an estimated 60–70% of Debswana's total revenue from all four of its mining operations combined. Let's do the social math to understand what $2.7 billion in annual diamond revenue actually means for Botswana. The country's entire GDP in 2023 was approximately $19 billion. Jwaneng's output represents roughly 14% of that total economic output, from a single hole in the ground covering just a few square kilometers. That's the equivalent of finding a mine in Nebraska that produces more economic value than the entire agriculture sector of Iowa, Kansas, and Missouri combined, or discovering a deposit in Scotland that generates revenue equal to 14% of the United Kingdom's GDP. The proportional impact is staggering. The revenue transformation is even more remarkable when viewed historically. At independence in 1966, Botswana had 2 kilometers of paved road total. Not 12,000 kilometers, not 1,200, but literally 12 kilometers of asphalt in the entire country. The capital was administratively located in Mafeking, South Africa, because Botswana lacked infrastructure to host its own government. The country had 22 citizens who had attended university. Fewer than most small American towns have college graduates. Almost the entire population was illiterate, with just 100 high school graduates in the entire nation spread across a territory the size of Texas. The infrastructure deficit was staggering. The colonial administration, operating on minimal budgets with little interest in development, had built essentially nothing beyond what was necessary to extract beef cattle for South African markets. There were no significant hospitals, virtually no schools beyond primary level, no telecommunications network, no electrical grid, and no port access since Botswana is landlocked. The newly independent government was so poor it relied on British aid for nearly half its annual budget, a dependency that made sovereignty somewhat nominal. Without external assistance, Botswana couldn't pay teacher salaries, maintain the handful of existing facilities, or provide even basic government services. Subsistence farming and cattle herding dominated the economy, with beef and hides accounting for over 90% of exports sent mainly to South Africa. GDP per capita ranked among the absolute lowest globally at roughly $70 per year, comparable to the poorest countries in Asia and Africa at that time. For comparison, the United States in 1966 had a GDP per capita exceeding $4,000. Even other African nations that had been colonially exploited, like Ghana or Kenya, had better starting positions than Botswana. The country was among the 10 poorest nations on Earth by any metric, with development indicators below even typical sub-Saharan African standards. Labor migration to South African mines represented a critical economic component. By the 1960s, over 50,000 Botswana men, approximately 50% of the adult male population, aged 1545, worked in South African gold and diamond mines, sending remittances that supplemented household incomes but depleted domestic labor. These migrants faced dangerous working conditions, discriminatory treatment, and extended separation from families, but economic necessity left few alternatives. The colonial legacy was one of deliberate neglect. Britain administered Bechuanaland Protectorate primarily as a buffer zone between German Southwest Africa, Namibia, the Boer republics, and British territories, not as a colony worth developing. The indirect rule system maintained traditional chiefs as administrators, while providing minimal investment, leaving indigenous institutions intact, but without resources or technical capacity for modern governance. Between 1966 and 1989, fueled initially by the Orapa mine that opened in 1971, and then by Jwaneng starting in 1982, Botswana achieved the world's fastest economic growth rate, averaging 13% annually. Peak growth rates exceeded 25% in the early 1970s. By 1990, GDP per capita had risen from $70 to over $2,000. By 2023, Botswana's GDP per capita reached approximately $7,200, placing it among upper-middle-income countries and the highest in mainland sub-Saharan Africa after South Africa. The World Bank formally classified Botswana as upper-middle income in 2007, a status it has maintained since. Diamond revenues funded an extraordinary social transformation. Access to safe water reached 95% of the population. The transition rate from primary to junior secondary education achieved 100%. Adult literacy rose above 85%. Government spending on education reached 25% of total public expenditure, one of the highest rates in Africa. Life expectancy at birth increased from 48 years in 1966 to 65 years by 1990, before declining due to the HIV/AIDS epidemic. Botswana became the first company globally to provide free antiretroviral treatment to employees and their spouses when Debswana implemented that program in May 2001. Infrastructure development exploded. Roads, schools, hospitals, telecommunications networks, all built with diamond revenues invested through disciplined fiscal management rather than squandered through corruption. Botswana established a sovereign wealth fund through the Pula Fund and government investment account starting in the MID-1990s to save mineral revenues. The government negotiated progressively better terms with De Beers through multiple rounds of renegotiation since the early 1970s, eventually securing an 85% share of profits generated by diamond mining in the country, far exceeding the typical 50-50 ownership split many would assume from the joint venture structure. This success wasn't accidental. It stemmed from competent and honest public sector officials, transparent fiscal regimes laid out in legislation like the Mines and Minerals Act and Public Finance Management Act, and dealing with a single company for mineral revenues rather than multiple operators playing governments off each other. Botswana ranks as the least corrupt country in mainland Africa, according to Transparency International's Corruption Perceptions Index, with a 2024 score of 57 out of 100, placing it 43rd globally. For context, that's ahead of South Korea, Poland, and just behind France and the United Arab Emirates. The country maintained budget surpluses for decades and accumulated foreign exchange reserves that reached 91% of GDP in 2007. Even after recent challenges from global diamond market volatility, reserves still stood at 7.3 months of import coverage by END-2023, well above the recommended minimum. But Jwaneng's story doesn't end with past success. The mine's future hinges on perhaps the most ambitious underground mining project ever attempted for diamonds, a $6 billion development that will transform how the operation extracts ore and extend production decades into the future. Open-pit mining at Jwaneng has already progressed through multiple phases, called cuts. The $3 billion Cut 8 expansion project began in 2010 to extend mine life to 2028, providing access to approximately 95 million carats of diamonds. That expansion delivered its first ore in 2017, after infrastructure and plant upgrades were completed in September 2012. The Cut 9 extension project, valued at $2 billion, pushed the open-pit mining timeline to 2035. This phase is expected to yield 53 million carats of rough diamonds from treating 44 million tons of material, with mining operations continuing at depths that test the engineering limits of open-pit extraction. But geology has limits. Eventually, the pit walls become too steep, the waste-to-ore ratio becomes uneconomic, and the only way to access deeper reserves is to tunnel underground. That's where the Jwaneng Underground Project comes in, and the numbers are breathtaking. In January 2024, Debswana's board approved a key development phase for transitioning Jwaneng to underground operations, with a total investment exceeding $6 billion. This marks the development of what will become the world's largest underground diamond mine, designed to access kimberlite reserves at depths of approximately 1,000 meters below the surface. The project is structured in multiple phases. The initial development phase focuses on establishing exploration access, creating a drilling platform through declining tunnels to enable detailed sampling of the deeper kimberlite pipes. This early access decline will also serve as the critical infrastructure backbone supporting future expansion stages. Phase 1 mining operations are expected to begin in 2028, with production ramping up progressively toward full underground capacity by 2034. At full operation, the underground mine will produce up to 9 million carats annually, roughly matching current open-pit output, but from much deeper ore zones that would be impossible to access from the surface. This underground expansion is projected to extend Jwaneng's operational life by at least 20 years beyond the 2035 open-pit closure date. Based on geological modeling, the underground operation could ultimately extract more than 50 million additional carats, sustaining Botswana's diamond-dependent economy well past mid-century. The technical challenges are immense. Excavating at 1,000-meter depths requires sophisticated ventilation systems to provide fresh air to workers and remove heat generated by rock pressure and equipment. At such depths, geothermal gradients mean rock temperatures can exceed 40 degrees Celsius, 104 Fahrenheit, making cooling essential for worker safety. Ventilation shafts must deliver millions of cubic meters of fresh air daily while exhausting stale air, a massive engineering undertaking requiring powerful fans, carefully designed air courses, and refrigeration plants to cool intake air. The mine will need to pump out groundwater infiltration continuously. Kimberlite pipes often act as vertical conduits for groundwater, and as mining progresses deeper, water inflow rates typically increase. Dewatering systems must operate 24/7 to prevent flooding that would halt operations and potentially collapse workings. Pump stations at multiple levels lift water incrementally to surface, with total pumping capacity potentially exceeding millions of liters daily. Stabilizing rock walls against collapse becomes increasingly critical at depth, where rock stresses exceed 30 megapascals. The kimberlite itself tends to be weaker than surrounding host rock, making it prone to failure if unsupported. Engineers will employ a combination of rock bolts, mesh, shotcrete, and steel sets to reinforce excavations, with ground support representing a major ongoing operational cost. Geotechnical monitoring systems using extensometers, stress cells, and seismic arrays will continuously measure rock movement to detect instabilities before failures occur. Hauling ore vertically upward through shaft systems presents another challenge. Rather than trucks climbing ramps in an open pit, underground operations use skip hoisting through vertical shafts, large buckets that travel up and down on cables, carrying 10-20 tons of ore per trip. Multiple shaft systems working simultaneously are needed to match open-pit production rates, with each shaft representing a major capital investment requiring 2–3 years to excavate and equip. De Beers and Debswana are applying lessons learned from deep gold mines in South Africa and advanced block caving techniques used at copper operations like Grasberg in Indonesia and Resolution in Arizona. The kimberlite will be mined using mass mining methods rather than selective extraction, with entire sections induced to collapse in controlled sequences. Initial works commenced in May 2024, with drilling rigs and excavation equipment mobilized to site. Engineers are advancing the decline tunnel downward at rates of several meters per day, installing support systems, laying rail and conveyor infrastructure, and establishing the underground workshops and refuge chambers required for safe operations. The financial magnitude is staggering. The $6 billion investment represents nearly 1/3 of Botswana's entire 2024 GDP. It's a bet-the-nation-scale commitment, but the alternative is watching diamond revenues collapse after 2035 when the open pit reaches its economic limit. Botswana's government has secured funding through a combination of retained Debswana earnings, domestic borrowing from pension funds, and international loans from institutions like the African Development Bank and OPEC Fund. The 2023 pension fund reform requiring 50% of assets be invested domestically by 2027 provides crucial capital for the project. Beyond Jwaneng's expansions, Debswana has undertaken continuous improvements to maximize ore recovery and processing efficiency. In 2013, the company commissioned a modular tailings treatment plant with capacity to process 2.5 million tons per annum, expected to produce 18 million carats over 20 years from previously discarded material. The mine achieved ISO 14001 certification for environmental compliance in 2000, the first mine in Botswana to earn that distinction. Operations maintain rigorous environmental management systems independently audited to international standards, along with OHSAS 18001 certification for occupational health and safety. Jwaneng owns and operates significant social infrastructure, including the local hospital, Acacia Primary School, and Jwaneng Airport. The mine's presence transformed the area from inaccessible desert into a thriving community, with modern amenities, job opportunities, and economic activity radiating across the southern region. But the story isn't without challenges and vulnerabilities. Botswana's overwhelming dependence on diamond revenues creates extraordinary exposure to global luxury goods markets, pricing volatility, and disruptive technologies like laboratory-grown diamonds. Since late 2023, the global diamond industry has experienced severe turbulence. Weak demand from major markets, particularly China and the United States, combined with oversupply and competition from synthetic diamonds, caused rough diamond prices to plummet more than 50% in just 18 months. Debswana responded by slashing production. Overall output fell 27% to 17.93 million carats in 2024, with sales revenues dropping 46% despite the volume reduction. In 2025, the company further cut production by 16% to 15 million carats company-wide, representing a cumulative 40% decline from 2023 levels. At Jwaneng specifically, operations at Cut 9 were paused for 3 months, starting in May 2025 to avoid flooding the market with high-value gems that would further depress prices. The temporary suspension demonstrated the mine's profound market power. When Jwaneng stops producing, global diamond supplies tighten immediately. The impact on Botswana's economy has been catastrophic in speed, if not unprecedented in type. Resource economies are always vulnerable to price cycles, but the severity and speed of this downturn caught many by surprise. After 2.7% GDP growth in 2023, the economy contracted by an estimated 3% in 2024, representing a swing of nearly 6 percentage points. Diamond exports, which had reached P6 1.7 billion, 4.5 billion in 2023, plunged to P4.4 billion in 3 billion in 2024, a 34.6% decline in nominal terms that translated to even larger real declines when adjusted for inflation. The fiscal impact cascaded through government finances. Diamond taxes and royalties, which had contributed approximately 30% of government revenue in good years, collapsed by similar proportions. Budget projections made in early 2024, assuming continued diamond strength, became obsolete within months. The government faced a stark choice: cut spending dramatically, borrow heavily, or some combination, all painful options. The fiscal deficit exploded to an estimated 8.9% of GDP for fiscal year 2024, ending March 31, 2025, among the widest deficits in sub-Saharan Africa and dramatically higher than the roughly balanced budgets Botswana had maintained through most of the 2010s. Even with consolidation efforts to reduce spending authorized in the 2024-25 supplementary budget, projections indicated a still sizable deficit of about 7.6% of GDP for fiscal 2025. Government spending cuts hit development budgets first. Infrastructure projects were delayed or cancelled, reducing construction employment and economic activity. The August 2024 budget revision cut recurrent spending by 4% and development spending by a harsh 22%. The 2025-26 budget formalized even deeper cuts, slashing the development budget by 21%, equivalent to P6.32 billion 465 million in reduced infrastructure, education and health investments. These cuts had real human impacts. Public hospital medicine shortages became so severe that President Masisi declared a national public health emergency on August 25, 2025. The government owed suppliers over P1 billion and couldn't pay, forcing emergency measures including releasing P250 million in funds and placing medical procurement under military oversight to improve efficiency and prevent further shortages. Public debt rose sharply from the historically low 20% of GDP in 2023 toward projections exceeding 40% by 2027 if diamond markets don't recover. While 40% debt to GDP remains manageable by international standards, far below levels in many developed nations, it represents a fundamental shift for a country that long prided itself on fiscal conservatism and minimal borrowing. The psychological and political impact of rising debt after decades of surpluses cannot be understated. Botswana's balance sheet deteriorated on a stock basis, moving from a small net asset position of 6.3% of GDP in 2023 to a net debt position of 13.2% of GDP in 2024. Government deposits at the central bank, once equal to 50% of GDP in 2007, providing enormous fiscal buffers, had declined to just 4% of GDP by 2023 and continued falling as deficits consumed remaining savings. The Pool-a-Fund foreign exchange reserves, though still adequate at 7.3 months of import coverage, fell from their peak of 91% of GDP in 2007 to approximately 25% of GDP in 2024. With domestic funds depleted, Botswana turned to international lenders for the first time in decades. The government secured over $500 million in loans from the African Development Bank and the OPEC Fund by MID-2025, marking a significant shift for a nation that had eschewed concessional borrowing during diamond boom years. These loans carry more favorable terms than commercial debt, but still represent external obligations that must be serviced from future revenues. Standard & Poor's downgraded Botswana's sovereign credit rating to BBB with a negative outlook in September 2025, citing falls in diamond revenue and deteriorating fiscal position. The rating agency warned that persistent weakness in global diamond demand could trigger further downgrades. However, the economy showed remarkable resilience by 3 quetzals, 2025, expanding 10.9% compared to the same quarter in 2024. The fastest pace in 5 years. Diamond traders surged 88.1%, while mining and quarrying activity jumped 39.5% as production resumed and prices stabilized slightly. This volatility underscores Botswana's fundamental challenge: how to diversify an economy so dependent on a single commodity that market downturns can tip the nation into crisis overnight. Diamond mining, which represented nearly half of GDP in the early 1990s, has declined to roughly 30% today. Progress, but still dangerously concentrated. The government and De Beers negotiated a new sales agreement in 2023 that attempts to address diversification. The state-owned Okavango Diamond Company will receive a larger share of rough diamond production, increasing from 25% to 50% over the 10-year term, to build Botswana's presence in cutting, polishing, and jewelry manufacturing. The agreement also established the Diamonds for Development Fund with an initial commitment of P1 billion, approximately $75 million from De Beers, potentially growing to P10 billion over time. This fund will support diversification projects in agriculture, renewable energy, tourism, and other non-mineral sectors. Tourism offers particular promise. The Okavango Delta, one of the world's most unique ecosystems, attracts high-spending visitors for wildlife viewing. Chobe National Park hosts one of the largest free-ranging elephant herds globally. Tourism contributed approximately 13.1% of GDP in 2019, though that fell to under 10% by 2024. But diversification proves enormously difficult when one mine generates revenue equivalent to entire industry sectors elsewhere. Jwaneng alone produces economic value exceeding what most countries derive from agriculture, manufacturing, or services. Competing with that through alternative development is like trying to replace the sun with light bulbs. The comparison to petrostates is instructive. Saudi Arabia, Norway, and the UAE have all struggled to diversify, despite decades of effort, and far larger economies of scale. Botswana's challenge is harder. The economy is small at $19 billion GDP. The population is just 2.6 million, and it's landlocked with limited access to ports. Yet Botswana has avoided the resource curse that devastated countries like Venezuela, Nigeria, or Angola. The difference comes down to governance, institutions, and leadership. From independence onward, Botswana's government prioritized transparency, invested mineral revenues productively, avoided unsustainable debt, and maintained democratic institutions. Sir Seretse Khama, the founding president who led Botswana from 1966 until his death in 1980, established the frameworks that enabled this success. His pragmatic, non-ideological approach focused on economic development without sacrificing civil liberties or democratic processes, a rarity in post-colonial Africa. Khama's successors, Kwet Masiri, Festus Mogae, Ian Khama, and Makwitsi Masisi, maintained policy continuity while adapting to changing circumstances. In 2024, the Botswana Democratic Party lost its majority for the first time since independence, ending 58 years of dominance, but the transition proceeded peacefully under democratic rules. This political stability, combined with effective public administration, allowed Botswana to negotiate progressively better terms with De Beers over 5 decades. Other African nations that discovered diamonds, like Sierra Leone or the Democratic Republic of Congo, saw mineral wealth fuel conflict and corruption rather than development. The De Beers partnership itself deserves examination. Why did the world's dominant diamond company, which historically controlled prices through monopolistic practices, agree to a 50-50 ownership structure with Botswana that evolved to give the government 85% of profits? Partly because Botswana's government proved to be a reliable, rational partner committed to sustainable production rather than short-term extraction. Partly because the deposits were so rich that even reduced profit shares represented enormous returns, and partly because De Beers needed Botswana's diamonds to maintain market control. The relationship became truly symbiotic. De Beers provided technical expertise, marketing channels, and diamond sorting infrastructure that Botswana couldn't develop alone. Botswana provided world-class deposits, political stability, and partnership terms that legitimized De Beers' operations amid growing criticism of the company's market manipulation. By 2015, Jwaneng was producing 7.87 million tons of ore, from which 10.4 million carats were recovered. The mine's proven and probable reserves stood at 88.3 million carats, across 70.1 million tons, grading 1.26 carats per ton as of December 2012, though updated resource estimates likely show different figures. At the current production rate of roughly 13 million carats annually, proven reserves represent only 6-7 years of remaining supply from the open pit. This is precisely why the $6 billion underground development is essential. Without it, Jwaneng stops producing around 2035, and Botswana loses its economic foundation. The geological context makes Jwaneng exceptional. The mine sits within the Arapa kimberlite field on a craton, an ancient stable section of continental crust that extends deep into the Earth's mantle. These cratonic roots provide the pressure and temperature conditions where diamonds form. Approximately 150 million years ago, during the Jurassic period, volcanic eruptions punched through the crust at supersonic speeds, carrying diamond-bearing rock from mantle depths exceeding 150 kilometers to near-surface positions. The molten rock, called kimberlite after the town of Kimberley, South Africa, where these pipes were first scientifically studied, cooled into vertical structures. At Jwaneng, erosion and sedimentation subsequently buried these pipes under Kalahari sand, concealing them from view. Without termites bringing indicator minerals to the surface through their mound-building activities, the deposit might never have been found. It's a reminder that major discoveries often depend on unlikely combinations of geology, biology, and human ingenuity. The quality difference between Jwaneng and most other diamond mines comes down to the proportion of gem-quality stones. Many diamond deposits produce primarily industrial-grade crystals, suitable only for cutting tools, not jewelry. Jwaneng's gems are predominantly monocrystalline, with common morphologies, including octahedra and dodecahedra. Spectroscopic analysis reveals a mix of nitrogen aggregation types, type Ya, type 1Ib, type 2A, and IAAAB variants, indicating formation under varying mantle conditions. The mine yields large, high-value stones, including the exceptional 1,098-carat specimen recovered in June 2021 that ranks among the largest known diamonds. Processing employs dense media separation, where crushed ore is mixed with heavy liquids and cyclones. Diamonds, which have lower specific gravity than the heavy media, float and are separated from denser waste minerals that sink. Secondary X-ray scanning then identifies and sorts diamonds from remaining concentrate. The completely automated aquarium project uses X-ray luminescence technology to detect diamonds based on their fluorescence under X-ray bombardment, a property that distinguishes them from non-diamond crystals with similar density. This automation eliminated human error in diamond recovery and dramatically improved throughput. Recovered diamonds are shipped to De Beers sorting facilities, where they're categorized by size, shape, clarity, and color into over 12,000 different classifications. This precise grading determines pricing, with large, colorless, flawless stones commanding prices exceeding $10,000 per carat, while smaller industrial diamonds sell for under $10 per carat. The social and economic impact extends far beyond direct mining revenues. Jwaneng's presence created a town where none existed, generating direct employment for thousands and indirect jobs in services, retail, construction, and logistics. The 2024 diamond downturn vividly demonstrated this dependence when unemployment surged as mining activity contracted. Youth unemployment in Botswana reached 45.4% in 2023, even before the diamond crisis intensified, reflecting structural challenges in an economy that generated wealth through capital-intensive mining rather than labor-intensive manufacturing. Creating sufficient jobs for Botswana's growing population remains an urgent challenge. The HIV/AIDS epidemic hit Botswana particularly hard, with over 20% of the adult population infected at the peak. Debswana's 2001 decision to provide free antiretroviral treatment represented pioneering corporate health intervention that helped bring the epidemic under control. Life expectancy has since recovered to approximately 65 years. Environmental management at Jwaneng focuses on water conservation, tailings disposal, dust suppression, and biodiversity protection. The mine operates in an extremely water-scarce environment where the Kalahari Desert receives less than 450 millimeters of rainfall annually, making every drop of water precious for both mining and communities. Tailings, the fine rock waste left after diamond extraction, are impounded in carefully engineered facilities designed to prevent contamination of groundwater. The modular tailings plant, commissioned in 2013, represents a second pass through previously discarded material, extracting diamonds that earlier technology couldn't recover. Reclamation planning for post-closure remains uncertain, given the 20-plus-year timeline extension from underground operations, but the mine will eventually face questions about what happens to the pit, tailings dams, and infrastructure when diamond reserves are finally exhausted. The geopolitical dimension of Jwaneng relates to Botswana's position in global diamond trade and the strategic importance of securing rough diamond supply. India processes 90% of the world's diamonds by volume in facilities concentrated around Surat and Mumbai, creating dependency on Botswana's production. China and the United States dominate diamond jewelry consumption, making their economic health critical to Botswana's prosperity. The 2024 slowdown reflected weak luxury spending in both markets, as Chinese property crises dampened wealth effects, and American consumers shifted spending toward experiences rather than goods. Competition from laboratory-grown diamonds poses an existential threat, potentially worse than temporary demand weakness. Synthetic diamonds with identical chemical composition to natural stones can now be produced for under $300 per carat at commercial scale, compared to $200 plus per carat for Jwaneng's natural gems, even before factoring in exploration, development, and operational costs. The economics are fundamentally different. Natural diamonds require finding deposits, developing massive infrastructure, moving millions of tons of rock, and processing at low grades, while lab-grown diamonds can be manufactured in controlled factory environments with predictable yields and scalable production. Technology advances in chemical vapor deposition (CVD) and high-pressure, high-temperature HPHT synthesis have dramatically improved both quality and cost structure of laboratory diamonds over the past decade. Early synthetic stones were obvious to trained eyes, with distinctive growth patterns and inclusions. Modern CVD diamonds can be virtually indistinguishable from natural stones, even under gemological examination, requiring specialized spectroscopic equipment to confirm origin. Production scale is expanding rapidly. Companies like Diamond Foundry, Lightbox, a De Beers subsidiary, ironically launched to compete with other synthetic producers, and Asian manufacturers have built substantial capacity. Global lab-grown diamond production for jewelry purposes exceeded 10 million carats annually by 2024, up from negligible volumes just 5 years earlier. At current growth rates, synthetic production could match natural diamond jewelry output within a decade. Cost curves are dropping fast as technology improves and production scales. Lab-grown diamonds that cost $800 per carat to produce in 2015 now cost under $300. With credible projections suggesting $100 per carat within 510 years as reactor efficiency improves and energy costs decline through renewable sources. If that trajectory continues, synthetic diamonds could undercut natural stones by 70–80% on price, while offering identical chemical properties. Consumer perception shifts represent both threat and opportunity. Younger buyers increasingly prioritize value, sustainability, and questioning traditional luxury norms. Marketing campaigns emphasizing natural diamonds' rarity and emotional significance resonate less with consumers who view natural as marketing rather than meaningful value. For many, an engagement ring symbolizes commitment, regardless of whether the diamond formed geologically over millions of years or in a reactor over weeks. However, the luxury segment, where Jwaneng's high-quality gems primarily sell, shows more resistance to synthetics. Ultra-wealthy buyers paying $50,000 for a 3-carat flawless natural diamond still prefer natural stones based on rarity, investment value, and social signaling. Lab-grown diamonds don't appreciate in value and lack the scarcity that drives luxury positioning. This bifurcation means natural diamonds might retain premiums at the high end, even as mass market segments shift to synthetics. De Beers and the Natural Diamond Council have fought back with marketing campaigns emphasizing natural diamonds' authenticity, rarity, and emotional significance versus synthetic stones' manufactured origins. But whether these efforts succeed in maintaining price premiums remains uncertain. For Botswana, the stakes couldn't be higher. If natural diamond prices fall by 30–40% from current levels, the economics of Jwaneng's underground development could deteriorate substantially. The $6 billion investment is predicated on selling production at prices that may not be sustainable if synthetics capture significant market share. The 2011 renegotiation of Botswana's sales agreement with De Beers gave the government greater control over rough diamond allocation, enabling development of a domestic cutting and polishing industry. The Jwaneng Diamond Company was established to take Botswana's allocation and develop value-added processing. However, building competitive diamond manufacturing proved challenging. Botswana lacks the skilled labor, infrastructure, and centuries of expertise that make India, Belgium, and Israel dominant in cutting and polishing. Training craftsmen and establishing quality standards takes decades, while the investment pays off only if natural diamond demand remains robust. Botswana's diversification efforts include the Diamonds for Development Fund established in the 2023 agreement, investment in tourism infrastructure, promotion of financial services, and efforts to develop agriculture despite challenging climate conditions. The government has prioritized education and skills training to prepare citizens for a post-diamond economy. Yet the numbers remain sobering. Diamonds generated approximately 80% of export revenues in 2023. When diamond exports fell by one-third in 2024, overall export earnings collapsed by similar proportions. Building alternative export sectors of comparable scale would require decades and billions in investment with uncertain returns. Norway provides an instructive comparison. That country discovered North Sea oil in 1969. 3 years after Botswana's independence, and built a $1.4 trillion sovereign wealth fund by saving petroleum revenues. But Norway had much larger GDP, population, and industrial base to build on. Botswana's smaller scale makes diversification proportionally harder. Some economists argue Botswana should focus on being the absolute best at diamond mining rather than pursuing forced diversification into sectors where it has no competitive advantage. The counter-argument: diamonds are finite and eventually run out, making diversification essential regardless of difficulty. The 2025 partial economic recovery demonstrates Botswana's resilience when diamond markets recover. 3 Quetzal's GDP growth of 10.9% was driven primarily by the 88% surge in diamond trading activity, as Chinese demand partially rebounded and inventory destocking completed. Mining output jumped 39.5% as operations resumed normal levels. This volatility, lurching between boom and bust based on global luxury markets, encapsulates Botswana's predicament. When diamonds sell, the country prospers. When demand weakens, everything collapses. Building a more stable, diversified economy remains the existential challenge facing Botswana's leadership. Looking forward, Jwaneng's underground development represents both opportunity and risk. If successful, it extends the mine's life to 2050 or beyond, providing another generation of diamond revenues to fund development and diversification. If diamond prices collapse from synthetic competition or permanent demand loss, the $6 billion investment could become a massive stranded asset. The project's timeline provides a narrow window. By starting construction in 2024, Debswana can potentially bring underground production online by 2028-2030, before the open pit reaches its limit around 2035. Any major delays could create a production gap that devastates government revenues and derails development plans. Financing the $6 billion investment during a period of weak diamond markets and constrained government finances required creative solutions. The decision to mandate that 50% of Botswana pension fund assets be invested domestically by 2027 was partly motivated by the need to mobilize capital for Jwaneng's underground development. This mandated repatriation of pension funds from foreign investments back to Botswana provides crucial domestic liquidity for government bonds and development project financing. However, it also concentrates pension fund risk in Botswana's diamond-dependent economy, exactly the diversification problem the country is trying to solve. International loans from the African Development Bank and OPEC Fund supplement domestic financing, with over $500 million secured by MID-2025. But Botswana has historically maintained low debt levels. Public debt was just 20% of GDP in 2023, and borrowing several $billion fundamentally changes the fiscal profile. If diamond markets remain weak and fiscal deficits persist, debt could rise to 40–50% of GDP by 2027–2028, according to Standard & Poor's projections. While that's manageable compared to many countries, it represents dramatic change for Botswana and reduces fiscal flexibility if another crisis emerges. The human dimension of Jwaneng's story centers on opportunity and transformation. Workers who might have spent their lives in subsistence agriculture or migrant labor in South African mines instead found well-paying jobs with health benefits, education for their children, and pathways to middle-class prosperity. The mine employs approximately 6,000 people directly and supports tens of thousands more through contractors and supply chains. Average wages significantly exceed Botswana's national average, with skilled positions like heavy equipment operators, geologists, and processing plant technicians earning substantial incomes by regional standards. Debswana's provision of free HIV/AIDS treatment, starting in 2001, extended to employees' spouses and dependent children, representing a massive healthcare investment that saved thousands of lives during the epidemic's worst years. The mine hospitals at Jwaneng and sister operation Orapa delivered care that many rural Botswana couldn't otherwise access. The educational support includes scholarships for mining engineering, geology, and technical training that built Botswana's domestic expertise. Early in the partnership's history, virtually all senior technical positions were filled by expatriates. Today, Botswana citizens occupy most management and technical roles, a testament to sustained investment in human capital. The broader economic transformation this enabled is measurable. GDP per capita grew from $70 at independence to over $7,200 by 2023, more than a hundredfold increase in 57 years. While not all Botswana shared equally in this prosperity, the poverty rate declined from widespread destitution to approximately 17.2% multidimensionally poor, as of 2015–2016 data. Access to electricity expanded from virtually none at independence to covering most of the population. Telecommunications infrastructure grew from barely functional in the 1960s to modern mobile and internet connectivity. Transportation networks extended from 12 kilometers of paved roads to thousands of kilometers of all-weather highways. Healthcare indicators improved dramatically. Infant mortality fell from extremely high levels in the 1960s to 30.5 per 1,000 live births by 2023. Maternal mortality declined as access to prenatal care and hospital delivery expanded. Despite the HIV/AIDS epidemic's toll, life expectancy recovered, and health outcomes significantly exceed most African countries. Education metrics tell a similar story. Primary school enrollment approaches 100%. With transition to secondary education nearly universal. Literacy rates for younger generations exceed 90% compared to widespread illiteracy at independence. The University of Botswana, established in 1982, produces thousands of graduates annually. These achievements came at a cost: excessive dependence on a single revenue source that generates wealth, but relatively few jobs. Botswana's unemployment challenge reflects the reality that diamond mining is capital-intensive, requiring massive investment in equipment and infrastructure, but employing relatively few people per dollar of output. Manufacturing sectors that might employ more workers, textiles, electronics assembly, Food processing struggled to compete given Botswana's landlocked location, small domestic market, and higher labor costs than Asian production centers. Tourism creates jobs, but seasonal demand and skill requirements limit opportunities. Government employment absorbed many job seekers during boom years when diamond revenues funded expansion of civil service. But that model became unsustainable when diamond revenues declined and fiscal pressures mounted. The 2024-2025 budget cuts that reduced the development budget by 21% eliminated thousands of planned positions. Botswana's Gini coefficient of 53.3 indicates substantial inequality, despite rising average incomes, a pattern common in resource economies where mineral wealth benefits some while others remain economically marginalized. Urban-rural divides persist as diamond revenues concentrate in cities, while rural areas rely on cattle herding and subsistence farming. The story of Jwaneng is ultimately about both extraordinary success and profound vulnerability. Success in transforming one of the world's poorest nations into an upper-middle-income country with strong institutions and democratic governance. Vulnerability because that achievement depends overwhelmingly on a single mine producing a luxury good subject to volatile demand. When termites brought indicator minerals to the surface in 1972, revealing the deposit buried beneath 40 meters of Kalahari sand, they set in motion economic forces that would lift millions from poverty. The December 1972 drill hole at Watley's Wish truly changed history. The $6 billion underground development beginning now will determine whether that history extends another generation, or whether Jwaneng's era ends around 2035, when the open pit reaches its limit. If synthetic diamonds capture market share and prices fall, the investment may not generate sufficient returns to justify its cost. But if natural diamond demand proves resilient, and Jwaneng's underground reserves can be profitably extracted, Botswana gains another 20-30 years to complete economic diversification. That time is invaluable, allowing tourism to mature, financial services to grow, human capital to develop, and alternative revenue sources to emerge. The mine that transformed a nation will ultimately test whether that nation can transform itself. Can Botswana build an economy less dependent on diamonds before diamonds are exhausted? Can it create sufficient jobs for a growing population? Can it maintain governance quality and democratic institutions amid economic stress? These questions matter far beyond Botswana. Resource-rich countries across Africa, Latin America, and Asia face similar challenges, leveraging mineral wealth for development without creating unsustainable dependencies. Botswana's experience, both successes and struggles, provides lessons for others. The partnership between government and mining company matters. Botswana negotiated ownership structures and profit-sharing terms that directed wealth to national development rather than foreign shareholders. This required sophisticated negotiation, political will, and legal frameworks that many countries lack. Governance quality matters. Botswana invested diamond revenues in infrastructure, education, and healthcare, rather than elite consumption or offshore bank accounts. Transparency International consistently ranks it among Africa's least corrupt nations because institutional checks limited opportunities for theft. Economic management matters. Saving petroleum revenues through sovereign wealth funds, maintaining fiscal discipline during booms, avoiding excessive debt, and planning for eventual resource depletion. These policies separate sustainable development from temporary resource windfalls that leave nothing behind. Political stability matters. Botswana maintained democratic elections, peaceful transitions of power, rule of law and property rights through decades when many African nations descended into autocracy or civil war. This stability gave investors confidence and allowed long-term planning. But even doing everything right doesn't eliminate fundamental vulnerability to commodity price cycles, technology disruptions, and the reality that mines eventually run dry. Jwaneng will not produce diamonds forever. The underground extension buys time, but geology ultimately imposes limits. The social math brings it home. $2.7 billion in annual revenue from 13.3 million carats at $200 per carat average prices. That's $7.4 million every single day, funding healthcare, schools, roads, government salaries, and social programs for 2.6 million people. Without Jwaneng, Botswana's government budget would face devastating shortfalls. Compare that to the United States, where defense spending alone exceeds $800 billion annually from a diversified economy generating $27 trillion in GDP. Botswana has no such diversification. It has diamonds and hope for successful diversification before the diamonds run out. As of late 2025, diamond markets show signs of stabilization. Chinese luxury spending recovered partially as economic stimulus measures took effect. American consumers continued purchasing despite inflation concerns. Lab-grown diamonds gained market share primarily in lower price segments, while high-end natural stones maintained pricing. This tentative recovery allowed Botswana's economy to post strong 3 quetzals 2025 growth after contracting in 2024. Government revenues stabilized as diamond royalties and taxes resumed. The immediate crisis eased, though structural vulnerabilities remain unresolved. Jwaneng continues operating 24 hours a day, 365 days a year. Komatsu haul trucks climb out of the pit carrying ore to processing plants. Dense media separators spin, X-ray scanners hum, and diamonds emerge from rock. The economic engine keeps running because Botswana's future depends on it. From termites bringing indicator minerals to the surface in 1969-1972, to geologists drilling through 40 meters of sand to find a December 1972 discovery hole, to engineers planning the world's largest underground diamond mine, requiring $6 billion and a decade to develop, to workers operating equipment in pits extending hundreds of meters deep. Jwaneng represents human ingenuity applied to geological fortune across more than 5 decades. The mine's operational continuity since 1982, 43 years of uninterrupted production through commodity booms and busts, global financial crises, the HIV/AIDS epidemic, and now laboratory diamond competition, demonstrates both the deposit's extraordinary quality and Debswana's operational competence. Few mines anywhere achieve 4-decade operational lives while consistently producing at world-class levels. The fact that Jwaneng has done so while remaining the world's richest diamond mine by value throughout this entire period speaks to the exceptional nature of the ore body beneath the Kalahari. But fortune alone doesn't determine outcomes. The difference between Botswana's success and the resource curse afflicting countries like Angola or Venezuela comes down to choices. Choices about governance, transparency, investment, education, infrastructure, and long-term planning. Jwaneng gave Botswana resources to make those choices. Whether the country uses the time purchased by the underground development to complete its transformation from diamond dependency to diversified economy will determine the mine's ultimate legacy. For now, 13.3 million carats per year continue emerging from southern Africa's Kalahari Desert. Processing plants separate diamonds from rock. Sorting facilities grade gems by size and quality. Auction houses sell rough stones to cutters. Polished diamonds eventually reach consumers' fingers as engagement rings and jewelry. Behind every stone lies a story of geological processes spanning 150 million years, volcanic eruptions punching through cratons, erosion burying pipes beneath desert sand, termites revealing what was hidden, and nations building futures on mineral wealth. Jwaneng, the place of small stones, turned out to be the place where an entire nation's destiny was transformed by diamonds buried beneath the Kalahari waiting to be found. That transformation isn't finished. The story continues underground, drilling toward reserves at 1,000-meter depths that will determine whether Botswana's diamond age extends another generation. One mine, 33% of government revenue. The world's richest diamond deposit by value. A nation's economic foundation and its greatest vulnerability. That's Jwaneng, and understanding its impact means understanding how geology, politics, economics, and human decisions combine to create the modern world's resource empires and their uncertain futures.